Hi, I'm Chad Padowitz, CIO of Talaria. Over the last few months, we've seen unprecedented challenges, including social, economic, health, and of course, financial. One of the most impacted groups in our communities is retirees. And what I'd like to do today is tell you a little bit about what's happening in the markets, as well as some solutions that might give retirees some respite.
Now, retirement investing is obviously different because there are different things that you should think about when you're closer to retirement or your clients are closer to retirement than obviously when you're accumulating assets at a far younger age. You're looking more for objectives. It's less relevant how well anybody else is doing or how much money other people are making in the market or other places, because you actually need to make sure that you yourself have the income and assets available to live the lifestyle you want in retirement. So a sustainable level of income from your asset base is of paramount importance. Secondly, liquidity. When you want the money, it needs to be there. You want minimal volatility, and this is a very important thing in the current environment, and this goes to sequencing, which I'll come to in a second. But there's three big risks in effect that you're trying to avoid when you're investing for retirement. One is sequencing, and there's no greater example than the current environment. A per annum return over 20 years is less relevant to when you actually earn those returns or earn that income. So a 40% drop in your asset base your first year in retirement is substantially worse than a 40% asset drop the latter part of your life. So it's a very, very important thing to make sure that the volatility along the way is very low, and that goes to sequencing. The other risk is obviously longevity. You need to make sure the assets will be there when you need them. And lastly, which is not an issue at the moment, but inflation can erode the asset base you have. So those are really the three risks you're looking to avoid, which don't always apply in other timeframes of investing. I think it's fair to say that the last couple of months have been quite extraordinary.
Firstly, dividends globally have been slashed. Just in Australia, 2 of the major banks have cut their dividends, and property trusts have cut those. As globally, this is a phenomenon as well, whether it's oil companies, property, banks, and so on. There's been substantial cuts in dividends. This is likely to continue when we look at the dividend swap market as an example, that is pricing in a 35 to 50% reduction in dividends for 2021. However, if you look beyond equities, other sources of income have also become significantly impacted and challenged. Over the last 11 years, whether it's cash, fixed income, and that's on the short end or even 10-year bonds, property trusts have also seen substantial reductions in yields. And that has only become more acute in the last couple of months. And this, unfortunately, is a trend we expect to continue for quite a few years. Another thing that I think is worth mentioning is the concentration within the current indexes in the current market. There are a small number of stocks that are becoming more dominant as a proportion of the index and are actually hiding the underlying economic realities of what's going on. For instance, the top 3 companies in the S&P actually have the same market cap as the 350 smaller ones. And when you look at returns, those are all up significantly year to date, while a vast majority of the equities market is actually far closer to its March lows. The market is anticipating this to be a very short duration impact on these companies. And in the absence of a V-shaped recovery in their earnings, we think a significant risk exists. Now, this risk, while it exists in those shares most specifically, is actually an index problem because they dominate the index. So if you are an investor in the index and you believe you are getting a level of diversification that tends to come with index investing, it is very important to consider that because that may no longer be the case today. There is another way of generating stable and consistent income, and that is actually via a process of selling put options to generate a premium that is effectively like income, but it is earned no matter what under every scenario, and it benefits from volatility, and it serves as a buffer against a loss. Here's a short video explaining how it works.
Put options are a promise to buy a stock at a specific price that is lower than the current market stock price, whilst getting paid an option premium for making that promise. Regardless of what happens to the stock price, we always get paid the option premium. If by the time the put option matures, the market price is at or below our promise price, we own the stock. If it is above, we walk away, but remember, whatever happens, we always keep the option premium.
Now that combination of buying shares that you want to own at a buffer, plus the income generated, plus being able to benefit from higher volatility, actually allows a far smoother return. Certainly for retirees, the journey is as important as the destination. There needs to be a comfort in the capital base and the consistency and delivery of that income in order to feel comfortable to spend it. And that is why the process we use is one that does not only generate those benefits, but does it in a smooth, consistent, less volatile manner. I hope this has been useful in understanding the challenges that are out there in terms of generating returns and more particularly income in these very challenging times. And certainly the options that are available that can help you mitigate some of those risks and provide a greater level of certainty. Thank you.